The illusion of market action and the hard truth. 10 hours of non-stop grinding. Your eyes are bloodshot, glued to the red and blue flashes on the screen. Your heart races with every single tick. But at the end of the day, when you finally open your trading account dashboard, what do you see? The account balance is exactly where it was this morning. No major profit, no major loss. What did you actually walk away with? An overwhelming, soul-crushing mental exhaustion, a profound inner emptiness, and 100 unanswered questions spinning in your head, asking, where the hell am I going wrong? Out of sheer frustration, you open up that exact same chart later that evening. This time, you do something different. You zoom all the way out, and you look at the entire day through a single daily candle. And right there, the light bulb goes off. You realize that from the absolute low of the day to the absolute high, the market had put down a clean, straight, beautiful 100 to 200 point move. Move completely devoid of confusion. That is the exact moment a brutal, terrifying truth hits you right in the gut. If you had just avoided the endless back and forth noise of the day and caught just that one single macro move, if you had taken just one solitary trade, the profits you failed to make after 10 chaotic trades and an entire day of agonizing effort would have been yours in a single click. That is the moment an eerie realization settles into a trader's mind. The way you are currently trying to make money in the market is fundamentally flawed. The real profit isn't where you're looking. The real profit is hidden entirely within that clean, uninterrupted highway between the daily high and the daily low, the exact space where you were completely absent all day. And this isn't just a bad day. This is the daily loop for every retail trader who sits in front of a screen trying to capture every single micro movement. The market operates on a very simple, unyielding mathematical law. Every single day, the market prints a range, a daily high and a daily low. Within this overarching range, a massive web of minor movements takes place. Prices bounce up, slide down, and whip back and forth. In professional trading, this is what we call market noise, or random distribution. But right in the middle of all that noise, usually once or twice a day, a massive, structural expansion happens. This expansion dictates the true direction of the day, and it represents the most critical window of opportunity. The tragedy is that the vast majority of retail traders burn 90% of their mental bandwidth, their emotional energy, and their trading capital inside that random noise. They react to every 1-minute candle, chase every minor pullback, and panic exit at the slightest hint of a reversal. By the time the real institutional move finally begins, they are either sitting on a massive loss or they are watching from the sidelines, paralyzed by fear, wondering if it's too late to get in. Tale of Vikram and the no man's land. To truly understand the anatomy of this psychological trap, let's look at the story of a trader named Vikram. Vikram has been trying to trade full-time for the past 18 months. He has memorized virtually every technical strategy available on the internet, plastered 5 different indicators across his charts, and bought multiple high-ticket courses. If you look at Vikram's raw win rate, it actually isn't bad. He wins about 50% to 60% of his trades, securing frequent small profits. Yet, at the end of every single month, when he opens his trading journal and looks at his net P&L, his performance is hovering right around zero. A little up one day, a little down the next, but completely flatlined once commissions, slippage, and fees take their cut. One weekend, out of sheer desperation, Vikram decided to run a data experiment. He pulled up his charts from the last 20 trading days, stripped away every single indicator, manually marked only 2 things, the absolute daily high and the absolute daily low for each day. When he stepped back to look at the data, the pattern was staggering. Every single day, without fail, there was a completely clean, one-way directional expansion from high to low or low to high that spanned anywhere from 100 to 250 points. Out of those 20 days, 18 of them featured a macro move that was beautifully structured and highly tradable. Next, Vikram took his actual execution history from those 20 days and overlaid his trades directly onto the clean charts. The reality that stared back at him completely shook him to his core. He discovered that out of those 18 massive daily opportunities, his entry was aligned with the macro move only 3 times. And even in those 3 winning trades, He had let fear dictate his exit, cutting the trade incredibly early and capturing a measly 20% to 30% of the total move. The other 15 trades he took over that 20-day period were executed entirely inside the random, choppy, sideways mid-zone where the market had absolutely no structural direction. It was inside those 15 low-probability trades that his profits and his capital were being systematically bled to death. For the first time in his career, Vikram realized that his problem wasn't his strategy, his indicator settings, or his entry triggers. His problem was location. He was playing the game inside a financial no-man's land, a zone where institutions and smart money completely step aside, leaving retail traders to butcher each other in a chaotic, zero-sum sandbox. Psychological framework. Why the brain craves action. This brings us to a fundamental psychological dilemma. If we logically know that macro moves hold the keys to generational wealth, why do our hands keep clicking the mouse inside the random mid-zone? The answer cannot be found in a chart pattern or a technical analysis manual. It is hardwired into the neurological architecture of the human brain. Mark Douglas explains in Trading in the Zone that the human mind is naturally maladapted to the environment of the electronic markets. When you sit down in front of your screens at market open, your brain is demanding one thing above all else: action. You have risked hard-earned capital, you have dedicated your valuable time, and therefore, your ego demands immediate feedback. Sitting completely still, waiting patiently, and doing absolutely nothing throws your brain into a state of severe cognitive dissonance. The legendary psychologist Daniel Kahneman famously demonstrated that the human mind processes reality through two distinct cognitive systems. System 1 is lightning fast, instinctive, automatic, and highly emotional. System 2 is slow, logical, calculative, and requires deep, conscious effort. When you are watching a live chart and the candles are aggressively ticking up and down, your System 1 completely hijacks your consciousness. It views every micro tick as either an existential threat or an immediate jackpot. The moment a massive green candle shoots up, System 1 screams, "Look at that volume. It's leaving without you. Buy now," driving you directly into the jaws of FOMO. The moment a red candle drops, it panics and screams, "The market is collapsing. Short it right now." This frantic decision-making does not come from a place of structural edge or statistical edge. It is born from an evolutionary survival mechanism that assumes all rapid movement is critical. Compounding this issue is the profound psychological phenomenon known as the fear of missing out on printed profits. The moment a trade moves just 10 or 15 points into green territory, System 1 is triggered instantly, whispering, "Secure the money now. If you don't lock this in and the market reverses, you are going to feel like a complete failure." This fear is so biologically overwhelming that you smash the exit button, taking a micro profit, completely ignoring the fact that your higher time frame structural analysis clearly indicates the move has just broken out and has another 200 points of runway left. Loss aversion and the pain of being wrong. On the absolute flip side of this psychological coin lies a devastating cognitive bias known behavioral economics as loss aversion. Human beings experience the pain of a financial loss at more than twice the psychological intensity of an equivalent financial gain. When a trade moves against your position and begins approaching your invalidation point, a completely different fear mechanism takes over. Your brain thinks, "If I accept this loss right now, I am officially realizing the pain. I am admitting that I am wrong. If I just hold on a little longer, the market is bound to bounce back." In this state of pure, unadulterated hope, you delete your stop loss or drag it further into the red. You throw logic completely out the window and begin managing your emotional survival instead of managing the trade. Mark Douglas heavily emphasized that in these moments, a struggling trader is no longer observing the objective structure of the market. Instead, they are merely projecting their own internal fears, wounds, and desperate hopes onto a completely neutral chart. When you routinely cut your winners short out of fear and let your losers run out of hope, you are committing mathematical suicide. Now, let's map this psychological defect directly onto the daily high and low concept. When the market drives downward and approaches the absolute daily low, what does the chart look like to the uneducated eye? It looks terrifying. It looks like a massive, unstoppable wave of selling pressure characterized by consecutive, heavy red candles. Retail trader's system 1 tells them the market is going to zero, prompting them to press the sell button at the exact location where global institutions and smart money are actively stepping in to accumulate shares. Trap snaps shut instantly. The second the retail trader enters their short position, the market violently reverses. Their stop loss is triggered in a matter of minutes, leaving another deep psychological scar in their subconscious. Now, as the market begins its true, clean, 200-point macro expansion upward from that accumulated low, that trader is left sitting on the sidelines, completely traumatized. Their emotional capital is so utterly depleted that they do not possess the psychological courage required to execute a valid entry on the unfolding macro trend. This exact same tragic loop plays out at the daily high, where retail traders get incredibly excited, and by the absolute top of the market, right as institutional algorithms step in to distribute their positions and send the market crashing back down. Structure of the market versus mental map. The most profound paradigm shift you must undergo is accepting the fact that the market is never the problem. The market is nothing more than a neutral mirror reflecting the collective psychology of its lattice. It opens every single day, maps out a low, maps out a high, provides a continuous stream of liquidity between those two structural boundaries. This mechanical process has occurred every single day for the past century and will continue long after we are gone. The market has never once forced a retail trader to over-leverage themselves inside the choppy, low-probability mid-zone. The problem exists entirely within your internal mental map. Your brain mistakes stillness for failure. It treats every single 5-minute candle as if it were a high-probability setup. And the objective reality is that true, institutional-grade setups only occur once or twice a day. The rest of the trading session is meant to be spent doing exactly what an apex predator does, sitting in complete silence, conserving energy, and waiting for the high-probability window to open. But the average retail trader interprets this waiting period as wasted time. They assume that because they are sitting at a workstation, they must be constantly producing output. This compulsive need to do something completely drains their cognitive reserves and wipes out their account balance right before the macro opportunity presents itself. Long-term profitability in this game has absolutely nothing to do with the frequency of your trades or how fast you can click your mouse. True success is determined entirely by your ability to align your capital with the macro expansions between the daily high and low. If you can train yourself to execute just one pristine trade per day that aligns with institutional order flow, that single trade will yield vastly higher financial rewards than 10 random trades inside the noise. If you want to transform your trading from an addictive gambling habit into a highly sophisticated business, you must systematically re-engineer your entire approach. To do this, you must adopt 5 non-negotiable structural rules into your daily routine. Rule 1 and Rule 2, constructing the map and executing patience. Rule number 1, which you must execute starting tomorrow morning, before the opening bell rings. You must explicitly plot the previous day high, PDH, and the previous day low, PDL, on your chart. These two structural lines are not arbitrary support and resistance levels. They represent your macroeconomic battle map. These boundaries tell you exactly where the most powerful entities in the financial world showed massive rejection, where true institutional buying materialized, and where heavy distribution took place during the prior session. Let's say yesterday's high was 22,500, and yesterday's low was 22,300. When the market opens today, these two price zones must be treated as the only areas on your screen that carry true statistical significance. If you fail to draw these lines before the session starts, you are entering the battlefield completely blind. You are looking at a chaotic landscape where every single candle looks identical, leaving your System 1 completely exposed to the illusion of action. But when those two macro lines are permanently etched into your screen, your visual focus is automatically locked onto the outer boundaries. The 200-point space inside those lines immediately becomes a designated no-trade zone, an area where you have absolutely no business risking a single dollar of your capital. This leads us directly into rule number 2. Until and unless the price physically reaches the previous day high or the previous day low, you must sit on your hands and execute absolute radio silence. This rule sounds incredibly elementary, but in the heat of live market hours, it is one of the most difficult behavioral habits to master. This rule forces a direct confrontation with your brain's addiction to dopamine and action. Imagine the market opens, and the price begins bouncing aimlessly around the middle of the range. Your System 1 will instantly fire up, screaming, "Look, market just moved 50 points higher. You're missing out on the move. Buy now." In that exact moment, you must take a deep breath, consciously observe the chart, and refuse to touch your keyboard. Doing absolutely nothing is an active, highly strategic trading decision. Every minute you spend in the mid-zone without taking a trade is a massive victory for your risk management profile. Rule 3. The anatomy of a liquidity sweep. Rule number 3 comes into play when the price finally breaks through the noise and arrives at your designated macro boundaries, the previous day, high or low. When the price hits these levels, a retail trader immediately rushes to enter a blind reversal or chase a breakout. You must do the exact opposite. You must sit back and observe how smart money interacts with the level. This is where the advanced concept of a liquidity sweep or a stop hunt takes place. Large institutional algorithms require hundreds of thousands of retail orders to fill their massive positions without causing massive slippage. Therefore, when price approaches yesterday's low, institutions will deliberately push the price just 10 to 20 points below that level. They do this with mechanical precision to trigger the stop-loss orders of all the retail traders who were long, while simultaneously enticing breakout sellers to enter the market under the illusion that a massive downtrend is starting. The moment these stops and breakout orders are triggered, a massive pool of sell liquidity is injected into the market. The smart money sits there waiting for this exact millisecond. They aggressively absorb all of those retail sell orders by buying them up, instantly driving the price back above the previous day's low. On your charts, this institutional manipulation is characterized by a long wick on a candlestick or a violent, rapid V-shape reversal pattern. The untrained retail trader misinterprets this flush as a genuine breakout, shorts the absolute bottom, and finds themselves trapped on the wrong side of the market at the exact moment the largest upward macro move of the day is about to launch. Your entire edge relies on waiting for this liquidity sweep to conclude. When you see price pierce a key macro level and immediately fail to accept lower prices, closing back inside the previous day's range, you have definitive structural proof that institutional accumulation is complete and the runway is clear for an explosive expansion in the opposite direction. Rule 4 and Rule 5. Expanding targets and eliminating noise. Rule number 4 dictates your execution mindset. Once the liquidity sweep is confirmed and your entry criteria are met, you must refuse to take a micro target. If you have successfully aligned your position with smart money at yesterday's low, your logical, structural target must be set at yesterday's high, or at the very least, the upper 80% quadrant of that macro range. This is the exact phase where 95% of retail traders completely drop the ball. They do the hard work of finding the perfect entry. The second the trade moves 20 or 30 points into profit, their survival instincts kick in. They panic, lock in a tiny profit, and watch from the sidelines as the remaining 150 points of the move unfold without them. Let's look at this through the lens of pure mathematical probability. Imagine a trader who spots a perfect liquidity sweep at yesterday's low and enters a long position at 22,300. His structural stop loss is placed safely below the sweep low at 22,280. Meaning he is risking tight 20 points. Yesterday's high sits all the way up at 22,500. If he allows his anxiety to take control and exits after a mere 20-point gain, he has achieved a basic 1-1 risk-to-reward ratio. But if he anchors his mindset in structural logic and holds that position to the previous day's high, his profit is a staggering 200 points. That is a 110 risk-to-reward ratio. This massive multiplier is the defining line between a professional market operator and a not a chus, perennially struggling amateur. This shift doesn't require a secret indicator. It requires the psychological stamina to let a macro edge play out to its logical conclusion. Rule number 5 cements this entire philosophy into a cohesive operational framework. You must permanently classify the mid-zone of the daily range as an absolute, non-negotiable, no-trade zone. When and prices hovering in the middle of the daily boundaries, your statistical edge is exactly 50-50. Taking a trade in this territory is nothing more than an expensive coin flip. Even if you happen to win a trade inside this choppy mid-zone, it is actually a massive net negative for your career, because it reinforces a highly toxic behavioral habit. Mid-zone doesn't have just bleed your financial capital through chopped stop losses and heavy fees. It completely eviscerates your cognitive reserves and your self-confidence. If you burn all your mental focus fighting 5 petty battles in the middle of the range, you will. Completely paralyzed when the pristine institutional setup finally presents itself at the outer boundaries. The anatomy of revenge trading and the 10-minute gap. Let us now dissect the single most destructive psychological crossroads every trader faces, the phenomenon of revenge trading. Imagine a scenario where a trader takes a valid, structured trade based on their plan. The market runs their stop loss anyway, resulting in a clean $1,000 loss. The exact second that loss is realized, a violent biochemical cascade takes place inside the brain. The ego interprets this loss as a personal insult. The emotional pain of being wrong triggers a desperate, primal urge to instantly claw that $1,000 back from the market. Mark Douglas points out that at this precise moment, the trader's focus shifts entirely away from objective market structure and becomes completely obsessed with getting even. The brain demands immediate emotional relief via an instant financial reward. To satisfy this craving, the trader completely abandons their disciplined process. They drop down from their structured 15-minute or 1-hour execution timeframes and load up a hyper-aggressive 1-minute or 3-minute chart. Because lower timeframes display rapid, non-stop candlestick movement, the frantic brain perceives this as an abundance of immediate opportunities to recover the lost funds. They begin clicking the buy and sell buttons purely based on the color of the last candle, doubling their position sizing in a desperate attempt to erase the loss in a single move. The 1-minute chart is a landscape of pure random noise. At the end of the session, that original, highly manageable $1,000 business loss has transformed into a catastrophic, account-shattering $10,000 drawdown. The critical lesson here is that the disaster was never caused by the first loss. Losses are simply a cost of doing business in financial markets. The disaster occurred entirely within that microscopic gap between the realization of the first loss and the execution of the next order. During that brief window of time, your cognitive brain has a choice. It can remain anchored in structural discipline, or it can submit to the amygdala and go into a state of emotional war with the market. To safeguard your capital against this trap, you must implement a hard behavioral circuit breaker. The moment a loss is realized, your next step is to immediately close your trading platform and execute a mandatory 10-minute timeout. You must physically stand up, step away from your workstation, and completely detach your eyes from the market until your System 1 cools down and your logical System 2 regains full operational control. Structural discipline and the professional journey. To fortify your risk management parameters, you must establish an absolute, ironclad, maximum daily loss limit. For example, strict 2% cap on your total trading equity. If you are operating with a $100,000 account balance, your maximum allowable loss for any single trading session is exactly $2,000. The millisecond your account equity hits that negative threshold, your trading day is officially over. Your platform is closed, your screens are turned off, and you walk away. It does not matter if the most beautiful setup in market history appears 30 minutes later. You do not touch the keys. This rule guarantees that your worst days as a trader remain incredibly small, predictable, and fully survivable. A bad day becomes nothing more than a minor speed bump on your equity curve, rather than a catastrophic cliff that takes months to recover from. When you audit your trading journal at the end of every week and explicitly categorize your losses into 2 distinct columns, planned losses, losses incurred while executing your valid structural setups, and revenge losses, losses incurred due to emotional overtrading inside the noise, you will see a shocking truth. You will see that your technical strategy was never the reason you weren't making money. You will realize that 80% of your capital leakage was driven entirely by trades executed out of pure boredom, impatience, or anger inside the no-trade zone. This is the ultimate reality of professional speculation. You do not need to master every single market condition. You simply need to become an disciplined sniper who remains completely motionless until the market enters your high-probability kill zones at the daily high and low. So, as you prepare to log into your trading workstation for the next session, make a definitive commitment to your professional growth. Map out your previous day high and low boundaries. Strip away the intraday noise, and learn to find peace in the stillness of waiting. In this game, wealth is not generated by the frequency of your actions, but by the pristine discipline of your patience. If this deep dive into trading psychology and institutional market structure brought massive value to your journey today, make sure to smash that like button right now and drop a comment below with the words "Trading in the Zone" to let me know you're committed to the process. If you're new to the channel and want to systematically level up your trading psychology, hit that subscribe button, turn on the notification bell, and never miss a masterclass. Manage your risk, protect your mental capital, and I will see you all in the very next episode. Until then, keep trading smart, keep learning, and stay disciplined.